SEBI yesterday evening put out a 40-page consultation paper and has proposed sweeping changes to the current total expense ratio charged by mutual funds. The proposal includes bringing GST and all transactions and brokerage costs within the TER. The paper also mentions revised slabs for various categories. There is equity AUM, non-equity AUM differentiation. What does all of this mean for the industry and the ecosystem? That's the question. And let's get this going with a discussion. Feroz Aziz is Deputy CEO, Anand Rathi Wealth. Manoj Nagpal is Managing Director, CEO, Outlook Asia Capital. And Mohit Gang is CEO, Moneyfront. Gentlemen, great to have all of you with us here. Appreciate your time very much on CNBC TV 18. Feroz, if I can start by asking you, the fear was, now some of this was well advertised, right? The SEBI chairman at that big press conference did outline her thoughts about the TER and how this is calculated, how it should be. She explained in detail. So the industry was expecting it. The fear was that there will be the TER will not be allowed to be raised, and all of these extra outside charges will have to be subsumed within these existing charges, which is not the case. There has been some lift up which has been allowed. In that context, Feroz, is this incrementally from what was being expected for the last 1 month a little more positive, or you think this is still pretty dire for the industry? Your sense?
See, I think it's positive. Of course, the expectations of each individual and a large participant could be different. But I think one thing which I see very positive, it's very exhaustive. See, if you gave incremental changes as a regulator, it becomes difficult for an asset management company largely to design its business models and go forward. Since it's so exhaustive, it's very, very positive, point one. Second, it's very consistent. It's not ad hoc. That's point two. Point three, like you rightly said, Prashant Bhai, that there is some degree of little more flexibility given from the paper and consultation, which has been happening for the last 6 months. The previous paper had 6, 7, 8 points. There was some feedback taken. And I think the feedback to a certain extent has been incorporated. So I'm loving the fact that it's exhaustive. It is not incremental. It is reasonably consistent. Point three, I think that out of these 10, 12, 13 points, if you categorize them as very good points, very progressive, there are some which are little regressive. The third are some confusing ones because you're also being propelled by retail. You don't want to give them too many choices, which makes decision making that much more difficult and becomes difficult for a person to make decisive decisions. So all in all, I'm reasonably happy.
Okay, reasonably happy. Well, let me get the other two guests in as well. Mohit Gang is with us, and Mohit has put out a very detailed thread on social media, a blog on the nuances of these announcements that came through. But no, Mohit, just summarize it for us. In totality, I think, it's beneficial for investors, for retail investors, because it helps not only cut costs for them, but also, curbs a lot of unfair practices by, say, distributors who are perhaps, pushing a lot of NFOs for higher commissions, etc. So just tell us from an investor standpoint, what does this mean?
Right, Sonia. Thank you so much. Look, I think from an investor's standpoint, obviously, as expenses go down, their performances and returns of the schemes will improve, right? And from an investor's perspective, for a very long-term thing, it's a fairly beneficial point. However, for industry participants, I'm sure this is not so great a news. Look, I think there were many practices which were happening in the mutual fund industries, especially the two practices which the paper comes out very heavily on are the NFO selling practices. So if you see data which the paper puts out from April 21 till September 22, the NFO money collected was around 86,000 odd crores approximately, out of which 27% of the NFO money collected was switched from the same schemes or from the schemes of the same mutual fund, which meant that what the practice on the street was that people were switching the existing portfolios of their investors and moving them into NFOs for higher commissions, because NFOs could pay out higher commissions because of the lower AUM they start with, right? Because the entire TER structure was AUM based. Now, SEBI comes out very heavily on this, and they say, okay, if you switch from any scheme now, the commission applicable will be the lower of the two schemes. So this complete practice goes off. Other practices like brokerage and transaction costs being included in the scheme TR. This is again a very high hit on the AMC profitability, to be very honest. I think because some of the schemes just thrive on churning. Some of the schemes just thrive on rotation of stocks. If you see arbitrage schemes or equity savings schemes for that matter, the volumes or the rotations of the trades are very, very high. Now, few of these schemes might go out of business totally if the transaction costs are included in the TER, right? And also schemes which thrive on very high churn might actually go out of the business. So there are few pockets which hurt distributors. There are few pockets which hurt the AMCs. And in all, I think the investor, the retail investor will finally end up benefiting a lot in terms of the lower costs of participating into these in mutual fund industry per se.
Okay, I just had one follow-up here. So you said that AMC profitability will get hit quite a bit, but is this commission structure such that it will be difficult for new players to enter and thrive or survive?
Oh, totally. I think, look, what SEBI says in the paper is that the industry has grown manifold over last 10 years. It's come to an sizable AUM of 40 lakh crores or so. However, to my mind, honestly, I think industry compared to what the overall financial ecosystem is fairly small and nascent right now. The mutual fund industry is just about spinning out on its own. If you compare it with the fixed deposit size or the banking size or the insurance industry also, it's not that big an industry currently. However, for new participants, let's say if today I want to start a new mutual fund distribution business on my own, the commission structure is not very lucrative, Sonia, right? To earn around 1.5% commission on an annualized trail basis, it will take me at least 3 to 5 years of very hard work to get to something which will just give me a sustenance kind of an amount. And not many new starters would have that kind of a capital or would have that kind of a patience to get into a standalone mutual fund distribution business now. So obviously,
got that. For distributors, I think the question was on AMCs. For AMCs, it actually incentivizes. Smaller AMCs are able to charge more. Larger AMCs, will charge lesser. But distributors, it's a different story, as Mohit also said. Rima, you have a question?
Yes. Manoj, there are two questions that I had. One, there are certain changes to the B30 incentives. B30 is beyond the top 30 incentives. So if you could just take us through the changes over there. And secondly, there is also talk about eventually moving to a performance-based incentive or commissions. Can you, reflect on both these two proposals?
Sure. So, the way I look at it is completely different. I think this just makes mutual funds a very better and more compelling investment proposition for investors. And what is good for the investor is always good for the industry also. So in my view, these are extremely positive changes. All the stakeholders, whether it is AMCs, whether it is investors, whether it is distributors, will get benefited because of the, it will help grow the industry size significantly. Coming specifically to your question on, the B30 incentives, over the last few years, there was a quagmire of charges which were outside the TER that were put. And for the growth of the industry, for a specific defined period of time, the B30 incentives were brought into place to help the industry grow beyond the top 10, 20 cities. Initially, it was known as B15. It was categorized only for the, beyond the top 15 cities. After that, it was taken out and made it wider to beyond 30 cities. And now that additional charges of 30 basis points is now in this new changes are supposed to be reduced and taken from the investor education budget. And I strongly am in agreement with this proposal from SEBI, primarily because any growth capital for the industry has to come from the AMC itself or the sponsor himself, not from the existing investors. That is what was happening earlier. It was required earlier because the industry was not growing, but industry has made significant strides in the smaller cities. So I think that's a very positive step, and the direction of the paper is very clear that what the investor sees in terms of total expense ratios is what he gets. So that is a very clear and transparent model that has been implemented at this point of time.
Okay, since all three of you are strongly in support, let me play the devil's advocate here. Feroz, so let's take one particular category, right? Let's take the balanced advantaged category, right? 40% equity, 60%. Let's assume it's like that and you're allowed to go up to a certain level. The paper itself, I think, does mention it in one of those pages. Will there be a perverse incentive to keep more in equity and not in debt because you're able to charge more on equity? Because now there are two separate sort of TER slabs, right, for equity and non-equity. Briefly, Feroz.
Yes, Prashant, like other panelists like Manoj and Mohit has as well said, that the industry is very nascent. We are just 16% as a percentage of our GDP. We are just 16%. Global is 63%. US is 1.4 times its GDP. Coming to your pointed question, I personally think on the debt side, you charging high doesn't work. And most people don't use the full TR anyway. Because the debt return is 6-7%, in which if you charge 1.5%, then it's still close to 25% or 20% of the total income. In equity, you have a potential of earning 13-15% return. There, you charging 1.5-2% as a percentage of the total income is just about 12-13%. That's point one. So I don't think that'll change asset allocation too much, because I don't think debt funds are utilizing the full capacity of the TR. Point one. Point two, with the new tax change, that's going to impact the debt funds anyway. And this TR reduction will enhance the return on a post-tax basis, even to a retail guy, because the Section 50A completely puts debt funds on a backseat. I think they will come back from a post-tax return perspective reasonably well. But I think if you look at the other 10 items elaborately, I personally think that there is a lot of benefit. And if you look at two very important items, Prashant, I'm digressing from your question, which will impact the AMCs is the exit load, 5 paisa. I think that was actually something which was given when exit loads, when there were exit loads of 1%, those 1% were added back to the AMC's profitability. A few years back, the SEBI said that you can't put it in your profitability, put it back in the fund. We are giving you 0.05% in lieu of that being taken away. And now that being taken away without that 1% coming back to the profitability seems a little unfair, because there's a lot of marketing effort which goes in to bring a new customer. When he goes out, you have to get back something from that kitty, because you've spent a lot of fixed and variable costs to get that client.
Okay. Manoj, towards the end of the discussion paper, it does talk about performance-linked charges as well. Now, it's a thought which the discussion paper leaves us with, says that we will discuss this with more feedback, etc. What do you make of it?
Yeah, so performance-linked, structure of fees is not really prevalent in the mutual fund industry globally also. So it does work in the hedge funds, managed portfolios, but it's not really prevalent. Now, I think the thought of SEBI is that if you're reducing expenses, bringing benefits to investors, there has to be an avenue for fund houses which also outperform and deliver better returns to investors to be able to charge this. So I think it's structurally a good thought process, but the implementation of this is a little difficult in the mutual fund structure, and we need to see the contours of this, how it gets implemented. But yes, incentivizing fund houses to move away from index hugging schemes. So what is happening is that large schemes, once they are able to generate large AUMs, become a little index hugging in nature. And that has been seen, and hence, the potential of generating alpha does reduce, and it ultimately does not benefit the investors. So I think this is a thought process to change that thought process and get into incentivizing fund houses to that. But we need to see the implementation, as I said.
Okay, the implementation is important. Got that. Mohit, I want to wrap up, with your comment. I mean, you did say that it could hit distributors badly, but what about the profitability for AMCs? What kind of, impact do you see there? And I also wanted your thoughts, why are there so many regulatory changes happening in the mutual fund industry itself? I mean, in 2022 as well, there were almost 5-6 changes that happened. Now, suddenly this. Is it that there were so many malpractices happening? Is it so, is it not supportive for an investor that SEBI had to come in? What do you see as the main reason behind so many changes in the industry?
Look, so I'll take the second part first, Sonia. I think every industry goes through its phase of evolution, and so has the mutual fund industry evolved over last 20-30 years. When the industry was small, obviously you need to incentivize the participants of the industry much higher to make the industry more favorable for them and to get newer investors into the fold of the industry. As industry grows in size and as volumes increase many folds, I think it is right on the part of SEBI to be more retail scale friendly to more investor friendly, because obviously the with larger size you will have problems of mis-selling or malpractices here and there, right? It's not a uniform case across the industry. But yes, few practices like B30 commissions being abused a lot in terms of how the industry was availing of it, or NFO selling or switches and all those kind of things, and selling schemes with higher commissions. I think overall SEBI is trying and making it more investor friendly and making it more uniform also across categories, and for the AMCs to charge that expense ratio. Now, when the expense ratio comes at an asset level and not at a scheme level, it will mean that your aggregate equity AUM for a particular AMC will get charged at a particular price, right? So there is, and investors have full transparency what all costs are going into it, right? To answer your first part, Sonia, I think from an AMC's perspective, my sense is the cost remains similar. Whether the industry is able to gain more volume, more traction, attract more investors, I think that will lead them to higher profitability. The margin impact, and SEBI paper also clearly brings out the impact on the revenues of AMCs. I think it is shrinking by around 4 to 5%, if it is what the paper spells out, which is as per the computation of the paper, right? So it's not a very huge impact. I think the volumes can easily absorb it if the industry continues to gain momentum, scale, size, and if the industry participants perform. And I think to Manoj's point, the industry has become more benchmark hugging. If they can beat the benchmarks, charge that performance fee, charge that variable fee to the investors, then they will have immense amount of profitability. If they can actually do justice to the performance, then I think there is a lot of money to be made for all the participants, not just AMCs in the industry.
All right, Mohit, thanks very much for joining us. Manoj, thanks very much for joining us. Firoz, great to speak with you. I mean, it's a 40-page paper, and it gives us so many rich points to discuss and debate. So this is a short one, but we will continue to focus on this as we go along.
Jefferies has come out with a note, and they're saying that SEBI's consultation paper can impact profits by 13%. That's a big number, right? 13%. So they're saying part of it will be passed on to distributors, brokers, other agents and partners.
We just scratched the surface. What happens to, for example, TER is what, expenses is what you pay brokers, etc., right? All the research that we talk about, all that costs money.
Yeah.
So if you ask brokers to subsume some of these costs, I mean, you share some and you ask brokers to share some, I mean, all kinds of things, quality of coverage, the number of stocks you can cover, the number of people you can hire, the entire ecosystem. But these effects will be seen over a period of time. But those numbers, I'm not sure. They're saying 13%.
13%. That's the Jefferies PDF which has come out. Though, of course, right now it's only a consultation paper. SEBI has sought feedback by 1st of June. Post-finalization, it may implement it in 6 months. Okay. So perhaps sometime next year, calendar year.
All right. Well, let's